Hello, everyone, and welcome to our discussion around net working capital and why it matters in M&A transactions. Our conversation today will be led by Ross Harris. Ross is an industry leader in the M&A space and a senior leader here at Transact Capital. Let's dive into our topic, net working capital.
So what is net working capital? This deck is mainly meant for business owners thinking of selling. So throughout the deck, when I say things like the word you, I'm going to be referring to the seller. Another important point is that this is how 90 to 95% of deals work. All deals are unique, so you may have friends or colleagues who have sold a business and working capital is handled differently. That's fine, but by far, most deals are going to go through the process I'm about to explain. Deals are done on what's called a cash-free, debt-free basis, with the sellers being required to leave the buyer a normalized level of working capital at closing. What this means is that on the day of closing, or really 2 or 3 days before the closing, you keep the cash you have in the bank, you pay off your debts, and you leave the buyer with what is considered a fair level of working capital, often also referred to as a normalized level of working capital. The point of this discussion is to explain the process that determines what is a fair level of working capital. Often you will hear bankers and other advisors refer to working capital as the amount of gas you have to leave in the tank to keep the car running after the deal closes. This is a great conceptual analogy, but it fails to mention that sellers often don't get to choose how much gas they think the car needs. There's a process for determining gas levels. Let's get into that process. This deck is going to be split into 3 parts. 1. How do you calculate net working capital? 2. How do you establish a net working capital target? And 3. How does a net working capital target impact your cash at closing? First, let's go over how the net working capital target is calculated. The first step is to calculate what the reported net working capital is. Reported net working capital simply means the net working capital as shown on your internal financial statements. Adjustments will need to be made to the internal statements, but we'll discuss those later. So go to your QuickBooks or your CFO and run the latest balance sheet. On the internal balance sheet, total current assets minus your total current liabilities equals reported net working capital. On this slide, we have a sample balance sheet for August 31st, 2023 that we'll refer to throughout the deck. In our example, total current assets is $7.5 million, total current liabilities is $5.7 million, which leaves us with a reported net working capital of $1.8 million. This will come up on the next slide, but we are going to discuss a lot about which line items are and are not included in the net working capital calculation. For now, just know by line items, I mean the accounts that are contained within current assets and current liabilities. In our example, the line items contained within current assets are cash, accounts receivable, allowance for doubtful accounts, inventory, prepaid rent, prepaid insurance, and deferred tax asset. As mentioned, in M&A transactions, adjustments need to be made to which line items in current assets and current liabilities are included for calculation purposes. There are 2 broad groups of adjustments: definitional adjustments and other adjustments. Definitional adjustments are adjustments made to the balance sheet to reflect the fact that deals are done on a cash-free, debt-free basis. Other adjustments include things found during due diligence and adjustments to accurately reflect what is agreed to in the final purchase agreement, all of which will be discussed shortly. For now, let's talk about definitional adjustments first. For definitional adjustments, cash and debt items are removed from the calculation. Since cash is being kept by the seller and debts are being paid off by the seller, those 2 items are dealt with outside of the net working capital calculation. Since they are being dealt with elsewhere in the transaction, they need to be removed from the calculation. Removing them from the calculation is the same as zeroing out those line items, which we have done on this slide. On the left, you'll see the original balance sheet that got us to the reported net working capital. On the right, you'll see the same balance sheet adjusted for the definitional items, which removes cash in current assets, and the line of credit, which is a debt item from current liabilities. We now rerun the net working capital calculation, which is current assets minus current liabilities, with these adjustments leaving us with a net working capital of $1.3 million. This will often be referred to as the net working capital by definition or the definitional net working capital. Next, we'll discuss the other adjustments that need to be made in a transaction. Other adjustments include tax-related items, debt-like liabilities, and adjustments to correct for improper bookkeeping found during due diligence. First, anything tax-related is going to be a responsibility of the seller and not assumed by a buyer at closing. This means it needs to be removed from the net working capital calculation. The second item in other adjustments are what are called debt-like liabilities. These can get complicated, and it is one part of the net working capital that is heavily negotiated before closing. These items get negotiated in the purchase agreement, which will clearly lay out which liabilities are debt-like and which liabilities are handled via the net working capital calculation. In general, it's going to be in the buyer's favor to treat as many liabilities as debt-like as they can, and conversely, it is usually in the seller's favor to do the opposite. An important concept for sellers to understand is that most often, any liabilities that are classified as debt-like are treated as debt at closing and will be a reduction in the purchase price. Common debt-like liabilities we see in transactions are credit cards, commissions, PTO and vacation, deferred revenue, and others. Once the purchase agreement has been negotiated and these items have been agreed to by both sides, we can move forward to the next step of the net working capital calculation, which is making the other adjustments. For example purposes, let's assume the buyer has a really good attorney and we decide to go with our divorce lawyer. So the negotiations went in favor of the buyer and most of the liabilities are treated as debt-like. Similar to the definitional adjustments, we need to remove the tax and debt-like liabilities from the net working capital calculation. On this slide, we now have our fully adjusted balance sheet. Let's go through each line item that has been removed. First is cash. This is a definitional adjustment and always removed. Deferred tax asset. This is tax related and generally always removed. Credit card payables. These are almost always treated as a debt-like liability and removed from the calculation. One exception is that if the business uses the credit card account in lieu of its accounts payable account, it will most likely be left in the calculation. Commissions payable. 80% of the time, this is going to be treated as debt-like. Occasionally, we can get away with keeping it in the net working capital calculation, but that really depends on the seller's business model. Vacation and PTO. This one is 50-50 and really depends on how the negotiations go. Line of credit. This is also a definitional adjustment and always removed. After all these adjustments, we now have our fully adjusted net working capital for August 2023 of $1.85 million. Once both buyer and seller have agreed to which line items are and are not included in the net working capital calculation, the formula for calculating net working capital is locked in and used throughout the closing process. There is usually an appendix to the purchase agreement that lays out in detail the calculation. Since we've learned the ins and outs of calculating adjusted net working capital, let's move on to how to establish a net working capital target. The net working capital target is the mechanism that determines how much net working capital a seller has to deliver to the buyer at closing, aka how much gas has to be left in the tank. Part 2 is going to cover how this target is established. The net working capital target will be a defined dollar amount in the purchase agreement and is something that is negotiated. However, the negotiations take place with a standard set of M&A principles in mind and generally revolve around two items. The first is which line items are and are not included in the calculation. This is what we just went over in part 1. The second negotiation point is over what time period the net working capital target covers. This is what we are about to go over. The net working capital target will be a monthly average of the adjusted net working capital over some historical period. Most often, this is a 3, 6, or 12-month look back. The first step is to do the exact same calculation we did in part 1 for the historical months. The example on this slide looks like a lot, but it is just the adjusted net working capital calculation we did on slide 9 applied to prior months. Since we already finalized in part 1 which line items are included in the calculation, you'll notice that the same line items are zeroed out for each month in this example. You'll also notice that the $1.85 million in net working capital for August 2023 matches the work we did previously. This slide allows us to establish a historical view of how our net working capital has fluctuated up and down each month. We'll use these historicals to set the target. Once you have the net working capital calculation figured out, determining a net working capital target is easy. In our example, we're going to calculate a 6-month and 12-month net working capital target. For a 6-month net working capital target, you take the average adjusted net working capital starting in March 2023 and ending in August 2023, shown in orange here. For the 12-month target, you take the average starting in September 2022 through August 2023. This is shown in the blue box. This gives us a net working capital target of $1.575 million or $1.607 million, depending on whether we use the 6-month or 12-month average. A net working capital target set using a 12-month average is the most common in transactions for stable businesses. For our example, let's use the 12-month average, which sets our net working capital target at $1.6 million. Again, remember, this means we have to leave the buyer $1.6 million in net working capital at the closing. We have now learned how to calculate adjusted net working capital and how to establish a net working capital target. Let's see how these two concepts impact what happens at closing. In this third and final section, we'll see how net working capital is handled on the day of closing. On the day of closing, the seller will need to provide the buyer what is called the estimated closing net working capital. This is simply doing the exact same adjusted net working capital calculation we have been doing in parts 1 and 2, but with the balance sheet as it looks on the day of closing. The purchase price delivered to the seller at closing will be either increased or decreased on a dollar-for-dollar basis, depending on how this estimated closing net working capital compares to the net working capital target established in Part 2. If the net working capital delivered at closing is higher than the target, the purchase price will be increased. The opposite is true if the closing net working capital is lower than the target. Let's look at an example. Let's assume that in our example, the transaction closes on September 30th, 2023. The seller will run the balance sheet on the day of closing as shown on the left side of this page. We'll then make the same adjustments to the balance sheet that were agreed to in Part 1, which gives us an adjusted net working capital at close of $1.75 million. This is also called the estimated closing net working capital. Remember, we established that the net working capital target is about $1.6 million. And on the previous slide, we saw that the estimated closing net working capital is $1.75 million. When we compare these two numbers, we can see that we are delivering $143,000 more in net working capital at the closing than we are required to according to the net working capital target. This creates a working capital excess of $143,000. The purchase price at close will be increased by this amount. The opposite would be true if we were delivering a working capital deficit instead. If the purchase price originally was $20 million, it would become $20.14 million at the closing. This slide is simply to remind listeners that there are many more purchase price closing adjustments in addition to the net working capital adjustment. We may cover those in later videos, but they are also important. These are some closing thoughts we wanted to leave you with. The first is that net working capital can get complicated quickly. The topics covered in this discussion are pretty basic, but hopefully give you a general understanding of how the process works. We recommend hiring a banker you trust and listening to their advice. The second is we've seen deals die over net working capital. If sellers are not familiar with how it works, closing can become contentious and deal threatening. Educate yourself on the process and seek quality advice. Don't wait until you're at the closing table to understand how all of this stuff works. The third is to negotiate as many deal terms at the LOI stage as you can. Net working capital is difficult to agree to at this stage because before due diligence is complete, there's just a lot we don't know. However, general concepts can be negotiated here, such as the length of the net working capital target look-back period. Hopefully this discussion has been of some value to you, and if you'd like us to send you a digital copy of this presentation, please shoot me an email at ross@transactcapital.com.